Good morning and welcome to the trade setup right here on BQ Prime. I'm Neeraj Shavi, trying to toy around with the idea of starting at about 8:05. Let's try and see if this works better for viewers to try and come in and log in at a time. We'll try it for 1 or 2 days, otherwise we'll revert to 8 a.m. as we usually do. Anyway, some global updates. So Janet Yellen says that high inflation is locked in for the rest of the year. It's 2022. No great shakes, but when Janet Yellen speaks, you should hear. EU and India have restarted talks, or likely to restart talks on free trade agreement, which is great news, right? We have Australia, we're doing it with the Middle East, and now we're doing with EU. All of this actually helps Indian exporters in a big way, right? So that's actually very good news. India net direct tax collections have risen 45%. You know, the one thing that is going for India is that the direct tax collections are really going well. So that's 2 or 3 things from an updates perspective. Then, after the worst weekly decline since March 2020, the trade updates, US futures have paired gains. So they were doing very well, and now they've paired some gains. So that is probably one thing that is not great news. Aside of that, Bitcoin and Ethereum have bounced off lows after a record-breaking rout. So they were doing very well. They were not doing well at all. They'd gone down all the way to Bitcoin. I think it got down all the way to 17,000. Let's stick with this plate. So Bitcoin had gone down all the way to 17,000, and then it's bounced back to about 20,000 or thereabouts. Currently, it's circa 20,000 odd. So that's the word on what Bitcoin is doing. Ethereum too, by the way, has kind of bounced off from the lows. But oil has slumped about 6%, possibly on demand concerns. So net from an equity perspective, risk on slightly, oil coming off, good. India tax collection slightly okay. World markets not so bad. A lot of damage already done. Maybe just maybe for a day or two or whatever, you might probably have not a bad outing. So the US markets, of course, did okay. So you know, the Nasdaq in particular, but the S&P too eked out some gains. But the US markets closed the worst week that they had in a long time, I think since March 2020. And the other cues, so if you just bring up the dollar index, which has been flattish, CBOE VIX still in the 31 zone, and the 10-year yield still about 3.23, off from the 3.43 highs, but certainly well above the three odd mark. So net, the other cues are okay. Asia was okay, and the SGX Nifty, which comes up on your screen next, we'll get the website up. Just try and show you what the SGX Nifty is indicating. A start of about 0.5% lower. Let's see if this continues, or can we have a bit of a trading bounce? Now, frankly, if you look at the trading perspective, the trade setup, the weekly gaps which are getting done are not getting filled. So typically in trading parlance, a lot of technical experts say that a gap gets filled and then there is some more upside, etc. Until that happens, nothing happens. But I mean, essentially weekly gaps not getting filled is pointing towards continued weakness. Experienced traders are talking about awaiting rallies to go short. So they are not wanting to initiate fresh longs. They believe there is downside, but in order to initiate a trade, they want to see a rally and go short on that rally. This is what some of the experienced guys are telling me over the weekend. There are no major global events lined up for the rest of the week per se, and therefore the focus is on micro. I mean, unlike last week, which was filled with central banking action, this time around, I think the US initial jobless claims is probably the only major action, aside of Jerome Powell testimony, of course, which comes in, I think, on 22nd of June, so Wednesday. But aside of that, nothing great in terms of global events lined up. Of course, the war continues, and the conversation between US and China, especially after what's happened in Taiwan, and US rejecting China's claims over the Taiwan Strait, might all lead to news flow around the world. But let's wait and watch. Lastly, I just when we look at trading supports from a market perspective, the few index heavyweights from the banking space are trading around some key support levels. And if indeed there's a pullback, you probably want to keep an eye out for this space, as that is the pocket that may lead on. This is purely from a trading perspective, very, very short term. And I'm not an expert here. It's something that I glean from various reports and various conversations that I have. Stocks to watch, though. It's a long laundry list today. So do watch out for that. I've not been able to include some of the stocks as well, so keep that at the back of your mind. But here's two very interesting brokerage notes. So one is, of course, JP Morgan on LIC. They've initiated coverage with an overweight rating and a target price of 840. So that is something you want to watch out for. It's difficult to pencil in why there could be near-term gains on a life insurance corporation of India, considering that a bunch of the private insurers too have corrected, and they are also They're probably doing much better on the business front too. Last week we did a very good conversation with Mayuresh and Gurmeet of Complete Circle on the pros and cons of investing in insurance. So difficult to gauge why, but JP Morgan is a noted house. Do watch out for this one. Jeffries on Sun Pharma is interesting. They've double upgraded the stock to a buy from an underperform. The target price has been raised to 910 from 775. They say the growth is expected to be driven by its specialty portfolio and India. They say the next 2 years growth will be driven by Illumia, Sequa, and Winlevi, while dependence on US generics is amongst the lowest in their coverage. They raised the FY23 and 24 EPS changes by 3 to 9%, and they say that the stock is now trading at its 5-year average, one year forward PE, and which probably brings the valuations okay. Now, different people think about it differently. There are some pharma experts who say that you shouldn't pay very high price to sales for some of these companies. And when I looked at the price to sales numbers for Sun Pharma, for example, I think it's upwards of 4 times or thereabouts. So it's not a cheap stock, if you will. So you got to keep that at the back of your mind right here. Sun Pharma is 4.8 times TTM price to sales. So from a price to sales perspective, it's not cheap, but PE maybe compared to averages is doing okay. So watch out for this as well. Now, viewers, there is a very interesting conversation. This is the one that I'm talking about. Sun Pharma is at 4.8 times price to sales versus a Lupin or a Reddy's or a Cipla. So keep that at the back of your mind. Now, we're doing a very interesting pharma conversation or a healthcare conversation today with Aditya Khemka of Incred AMC. He's a fairly noted pharma fund manager. So you may want to tune in for that at 9:30 today. Okay, let's move on to next. Iron ore apparently faces a really key week as the test of $100 mark looms, and therefore NMDC remains in focus. The oil companies remain in focus because Asian energy related shares have slid after oil has dropped amidst demand or as well as rate concerns. Remember, 6% correction in oil, as I told you just a minute ago, and that may have some bearing on the ONGCs, Oil Indias of the world, maybe even BPHP of the world. Remember, crude is at 113, and all Asia energy companies have come off today. So watch out for maybe a bit of a slide into these stocks as well. Some stocks in focus include a Delta Corp. This was kind of known Friday, but I'm just reiterating again. Friday during market, as I'm saying, this was known, but I'm reiterating that Rakesh Junjunwala has sold some shares. Reportedly 57.5 lakh shares at 2.15% at 167. FIM, Sage One Investment Managers, has bought about 2.8 lakh shares at 1,020 a piece. Samit Vartak is a really smart stock-specific stock picker, so to say. So they've bought it under 2 schemes. So do watch out for FIM. In case there is a reaction, you would know why. Yes Bank, Carlyle Group eyes about 10% stake as per CNBC TV 18. Even my colleague Vishy has spoken about this. So do watch out for Yes Bank as well. I'm not speaking about Delta Corp's unit Delta Tech Gaming, which is filed for an IPO, or Inox Wind's unit Inox Green, which is filed for an IPO. If these IPOs find some success, then maybe the parents might benefit, and therefore from that perspective Delta Corp or Inox Wind might benefit. But for now, I'm not quite mentioning them as key triggers because it's just a filing of the fighting for the IPO. I mean, let's wait to see what the response is before we try and run our horses high. One more brokerage call on Apollo Tyres. Actually, I think they did, Motilal Oswal's note. They maintain a buy with the target price of 265, which is a significant upside, by the way, from the current price. They say it's all geared up for the next leg of growth with sufficient capacity to cater to demand from India and Europe. The increase in capacity utilization will generate higher cash flows and further deleverage its balance sheet. They say it offers the best blend of earnings growth and cheap valuations versus peers. And they value the stock at 12 times June 24 EPS versus a 5-year average of about 16 times to 12 times. So versus 5-year averages of 16 times, they value it only at 12 times. So they're trying to probably say that the valuation multiple is not demanding as well. Now, oil is off today, and therefore that might also aid, but otherwise oil is still not completely gone as a concern. And therefore, I don't know how much of a havoc it continues to play on companies which derive oil and rubber as a key raw material source. But clearly, as you can see, the valuations are not very demanding. If you do believe autos are going to come back in some form of time, then maybe Motilal Oswal certainly believes so, and that's why they have this rating on Apollo Tyres. Lastly, viewers, I'm borrowing a lot of brokerage notes today. There's not too many stocks in news, or at least the ones that I've missed. For example, no, just before we do this, Jeffries on cement, watch out. For example, there is a lot of newspaper reports today about how the land license fee (LLF) will be cut this week. So that brings Concord into play as well. There is a fair degree of conversation about how sugar prices are set to inch up higher because of a global deficit, and because India will not be able to add further to exports as well. So therefore, that might bring some of the sugar stocks in focus. But difficult ones to call, and therefore I'm not quite mentioning them as stocks which are in news. But a pocket that should certainly be in focus is cement, and I think that Jeffries note nails it down really well. So they say they've seen Shree Cement announcing a greenfield capex in the market of Andhra Pradesh by FY25. So Shree's capex, according to them, further adds fuel to concerns on a glut of the sugar supply additions in the industry supply additions. Remember, Adani has said that they want to move to whatever 140 million tons on ACC Wholesome or ACC Ambuja Wholesome. Ultratech correspondingly has also made a fairly large capacity addition plan made visible. Now, Shree Cement, which is also a market leader, is trying to do that. Imagine the quantum of supply that is coming into the markets over the course of the next 3-4 years, if all goes as per plan, of course. So Jeffries is saying that the price hikes have lagged the cost increases, and there are valid concerns around supply pressures. With onslaught of new capex announcements by the industry majors, stocks may remain under pressure until any major price hikes are in place. Now, remember, the street is very divided. There are some fairly smart opinion makers who we've spoken to as well in the past when the wholesome deal happened, who have said that in some pockets, in certain cases, cement stocks might actually do really well because the valuations are comforting, as they had made a case for. I think Rakesh Arora made a case for Ambuja, for example. But uh, it's a divided house, and I see a lot of merit in the arguments being made by Jeffries as well. So remains to be seen. But I think a lot of people would say that there are other sectors to bet on. So why bet on a sector which is actually on a capex drive, which will bring in a lot of capacity, and therefore there could be some pricing concerns in the near term or the medium term, if not the near term. So argument has some validity. Wait and watch what happens to cement. Lastly, do watch out for the sovereign gold bonds. The first tranche of the SGB scheme for FY23 is open for subscription. There are a lot of fans here, in India, who like gold and who would want to go on for the sovereign gold bonds, because at least you get some bit of interest as well, and the price mimics the price of gold any which way. So that has started in the remote chance that somebody wants to apply to the SGBs. So do watch out for those. Net viewers, be careful. Difficult to call out a trade, and I'm not in that business any which ways. But yeah, some of the stocks that are in focus are interesting, and do watch out for banking. As per what people say, that there are some stocks which are trading at some fairly crucial support levels. They could see a bit of a bounce if indeed there is a bounce back in the market at large. Doesn't seem like what happened today, but the stage is set. I mean, the markets have been sold off quite a bit. Oil has come off. Global markets are doing okay, and Bitcoin's bounced from the nadir, suggests that at least there's some bit of appetite for even risk assets at lower levels. Let's wait and watch if that happens for Indian equities or not. Oh yeah, keep in mind the tax collections and the EU free trade conversations might all add to some positivity. Thanks so much for tuning in. Have a safe day ahead.